Good morning and welcome to the Naples Money Managers News You Can Use. It is March 7th, I believe, 2022. That's still having a little trouble getting that out.
Where did the last 20 years go?
I don't know, but based on our looks, it didn't go anywhere because we still look the same.
Oh, okay.
That's what I meant.
I was trying to draw a conclusion there, and I didn't want to go there.
Yeah, but you have a lot more color than I do. You can tell you live near the water. I'm going to do something different today. Last week we talked a lot about the roller coaster ride. You know, we're all excited, and then we're feared, and then we're excited, and then we're scared, and how important it is not to get off during the ride. But I don't think we're really addressing the fear that people have out there. And that is, what if it doesn't come back? What if it's not a roller coaster ride? What if it's a long ride down the hill and a really struggle back up the hill? What if that happens, right?
That's right.
And when you think about it, as Dennis always says, a bear market doesn't give you a warning, like a big pew. It eats you a bite at a time. So you don't hardly know what's happening.
That bear eats you a bite at a time.
And it's always stuck with me, and it gives me a basis from which to draw conclusions. So we thought what we would do, there was this great article in one of the magazines I was reading called Lost Decades, and it talks about something we've talked about a lot, which was from the year 2000 to the year 2013. If you put $1 in 2000, it took you all the way to 2013 to get your dollar back. And that was if you never took any money out. If you took money out, you never got your dollar back. So basically,
for sure,
yeah,
you would never get back.
Yeah, if you had $1 million and you took out 50,000 or 5%, but you took out 50,000 every year, all the way down, and continued to do it even on the way back up, your $1 million would be worth about $365,000 in real dollars. So that long period of time.
It really eats you up.
And
speaking of being eaten up.
Right, so they talk about these lost decades here, and that there were three in particular. 2000 to 2013, 1968 to 1983, 1937 to 1950, and they didn't even want to go to 1929. So there really were four of them.
Yeah, they thought that would be piling on.
And I guess another important thing is they talked about the sequence of events. You know, it's not one thing. It's always a cascade of things that cause a real bear market, not just one, like the war in Ukraine. I mean, that's bad, right?
Right.
And oil prices are going up. There's another thing, right?
That's bad.
That's bad.
Inflation is going up.
And that's bad.
That's bad.
So you start to look at these things in a cumulative factor and try and determine what they're going to do to the market over the long run. And basically, we always tell people if you have 20 years, you're going to be fine. But I'm going to add 20 years plus to that when you're purely invested in the markets. They talked about things like, you know, in the dot-com bubble of the year 2000, right? Which with irrational exuberance. Do we have irrational exuberance right now? Look at the property on my street.
We kind of have, yes.
Oh my God! I can't believe what it's selling for. It's insane. And, you know, that's irrational exuberance, if you ask me. All the frauds we had with Enron and WorldCom, and you follow that with the trifecta of the subprime mortgage meltdown, Bear Stearns and Lehman Brothers, that propelled that 2008 banking crisis, and the subsequent, the pigs crisis. You know what that is? Mr.
Portugal,
Yep.
Italy, Greece,
Nope. Portugal,
and Spain.
Ireland, Greece, and Spain. Not Italy, believe it or not. We Italians.
I
what
thought
can I
that
tell
I
you?
was Italy.
Yeah, nope. I was Ireland, oddly enough. So the reason I bring this to everyone's attention is because what can you do if that's going to happen right now?
Yeah, you have to have a way of smoothing out those ups and downs.
So the first thing you do is get rid of your irrational exuberance. Number one, take that off the table. Right?
Absolutely.
Get it off the table. Number two, be willing to settle for a reasonable return, not something crazy that everybody expects these days. And the markets really haven't gone to that exuberance level yet. I think real estate has, but not the stock market.
The stock market wasn't there, I don't think.
Yeah, I don't think it's there yet because there's still too much cash on the sidelines.
A lot of cash.
And that's a good sign that we're not at irrational exuberance. But why should we wait for that?
Yeah, events might catch up with us.
That's right. And you know as well as I do, we're never ready. Who's ever ready, you know? So that's why the strategy we use really works. And so what I asked Marcus to do is to pull out our returns from the year 2000 to the year 2013. And oddly enough, we only had 2 down years, 2002 and 2008, both which were down 18 and 19% respectively. But over the long term, all the rest of the time was up. And even though our clients were taking money out during this very irrational time, still had the principal plus.
Yep.
Not just principal, but principal plus. So what you can do if you're new to this, you can look at our covered call strategy. We call it the power of Mapato. They're powerful because it is double income. And that's what keeps you safer. It keeps your seed corn or your principal secure, right?
Keeps the seed corn safe and provides the base for the coming rally, whenever that may be.
And it's liquid. That's the other thing. So you do, as Dennis said, you want to be ready in case the market continues to go up. You don't want to be out entirely.
Yeah, people a lot of times think, okay, well, I'll just go to cash. Whatever reason, that never works.
Nope.
How many times have we seen somebody who got out at the low from the previous bear market, only to get back in at the high
When they
on
can't
the
stand
next
it
one?
anymore.
When they can't stand it anymore.
So the first thing you can do is look at that. You can look at the rest of your investments and see how exposed you are to the market and find ways to protect them. For those people who are what I call vulnerable millionaires, the right annuity is often the right thing to do if you still need growth. But quite frankly, if you're okay where you are, how much is enough?
Well, how much is enough? That's true.
You know, if you're 40, it's different than if you're 65 or 75, right?
Well, that's true. But you also have to figure inflation in there and the rest, but still.
Yeah, I mean, you know, we like to build wealth, but not at the risk of losing it.
That's the thing.
Okay.
You don't want to risk more than you afford to lose.
So I guess what we wanted to do today is say, here's a solution. Here's something you can do if you feel there's just too many things going on, too many factors that are negative, and we have this irrational exuberance on the brink. You can look at this portfolio if you already have it. Tell somebody about it, because you know everybody's going to be complaining pretty soon their portfolios are down 40%. It's going to happen.
Oh, yeah.
It's going to happen, and it may happen without us being prepared.
Oh.
Not us. You.
Hopefully not, but it will happen sometime.
Right. And you've got these old people here who have been through many 40% down markets. We know what we're doing. We know what we're talking about. And then we've got our younger, more energetic and technology savvy people who are just as smart, but blended together, we make an amazing team. So this is Money Matters, but most of all, and most importantly, you matter. Have a great day.